Good day. Thank you very much for coming to the first seminar of our Pension, Retirement, and Aging Seminar Series in 2023. So a very late Happy New Year to everyone, and hope you all have a very refreshing start of the new term and the new year. So as the first speaker, I'm really glad that we managed to invite Dr. Thomas Davidoff to be the first presenter to share his research work. Firstly, I will acknowledge the traditional owner, and then I will give a brief introduction of Dr. Thomas Davidoff, and then we will have his presentation. So I'd like to acknowledge the traditional owner and the custodian of the country throughout Australia with their continued connection to water, land, and culture. I specifically acknowledge the traditional owner of the lands where this meeting is holding today, that is the Bidjigal people. And we also extend our respect to the elders, past and present. So now allow me to introduce Dr. Thomas Davidoff. He's an associate professor at the University of British Columbia. He's also a director of the UBC Center for Urban Economics and Real Estate and holds the Stanley Hamilton Professorship in Real Estate Finance. Tom's research interests include housing, aging, insurance, and mortgage. Sounds like you're the perfect fit to our seminar series. Tom has rich experience working in and with industry, alongside his academic life with publications in several top journals, including the American Economic Review, Journal of Public Economics, Journal of Economic Behavior and Organization, Journal of Urban Economics, and Real Estate Economics. The last thing to highlight, Tom has been working as the Journal of Housing Economics editor since 2011. Okay. Thank you very much for sharing your research work today with us. And that's your time.
Great. Thank you so much. And thank you all for being here again to talk about another group of, I guess, traditional stewards of the land, longtime owners. Okay, so I think the research question is really stated in the title. Do reverse mortgage borrowers use credit ruthlessly? Not to be pejorative with ruthless, but ruthless in the sense of financially, in a financially sophisticated way, exploiting an option, a put option embedded in reverse mortgage loans. Okay, so here's the research question by way of a numerical example. You can change the numbers, but this is the fundamental question. Okay, so consider a reverse mortgage borrower. Reverse mortgage loans are collateralized by homes and generally non-recourse. And in the US, the home equity conversion mortgage, typically borrowers chose lines of credit. And the lines of credit actually behaved in a slightly more complicated way than this, which is the credit limit grows with the mortgage balance that you would have if you drew everything in year one. So if it's a 5% interest rate and I've got a $100,000 line of credit, if I don't borrow it all in year one, I can borrow $105,000 in year two and a little bit more than $110,000 in year three, et cetera. But put that aside. So consider a borrower with just a plain vanilla credit line up to $100,000. And they've used $50,000 to date, and they're about to exit their home. Maybe they have warning that they're going to die. Maybe they're moving in with their children, downsizing, what have you. Okay. So we've got a $100,000 credit line with $50,000 remaining. Now, they borrowed this reverse mortgage when the home was worth $200,000, but maybe it was Merced, California, or somewhere that had an enormous boom and bust cycle. And now the collateral is only worth $70,000. Okay, so given the non-recourse nature of the loan and given adverse selection that we've seen, there's strong reason to think that what the borrower should do is, if you like, dine and dash. They should grab the remaining line of credit. Now they owe $100,000, but they're not going to pay back $100,000 from selling the home. Rather, the lender will get the home, or they'll sell the home, however it is, to a third party. There's only going to be $70,000 in proceeds. They'll be $30,000 short, but that's the lender's problem, and the lender kicks that problem up to the Federal Housing Administration. Okay, so if they don't draw the remaining line of credit, essentially they're failing to exercise an in-the-money put option because they can get a total of 100,000 out of the house, even though it's worth only 70. Okay, so the question is, in cases like this, do we see reverse mortgage borrowers drawing that remaining $50,000, or do we not? And the data comes from the U.S. home equity conversion mortgage, and I'll focus on loans originated 2006 to 2007 and terminated 2009 to 2011, and you'll see shortly why I picked those years. Okay, so that's the question. Do we dine and dash? Do we grab any remaining line of credit before we leave, or instead do we leave money on the table? Okay, why is this question interesting? Well, reverse mortgages are one of what I sometimes call the holy trinity of retirement finance actuarial puzzles. So reverse mortgage, you've got a house that's worth way more money than your financial assets. It seems very attractive to spend some of the home equity that you have prior to death or moving out, because you've got a long period with low consumption and then a giant financial windfall. So it seems like a great idea. Additionally, in the Holy Trinity, we have life annuities and long-term care insurance. And all three of these seem like really important consumption smoothing tools for retirement because health, longevity, and stochastic and illiquid housing liquidation are just three very important factors in retirement finance. And yet all three of these markets are small. Part of my research has been to show that they're integrated. If you don't have a reverse mortgage, that makes life annuities less attractive. And it also may make long-term care less attractive and vice versa. If you don't have long-term care, reverse mortgages become less attractive because you may want to hoard home equity as sort of self-insurance. Okay, so why is reverse mortgage puzzling? Well, it's not just the intertemporal consumption smoothing. The put option that says your liability when you leave the home is limited to the value of the home, that means you've got three important hedges. One, against longevity. So we saw John Calmont in my last talk. If you live to be 120 years old, you can borrow more money than you have to repay. So because there's a spread on the loan, people who die young are subsidizing people who live for a long time, and that's a form of longevity hedging. If interest rates rise over the course of your stay in the home, these are typically variable rate mortgage loans, and so you've got to hedge against interest rates. Moreover, of course, and that's really the point of this talk, is you've got to hedge against falling housing prices. To the extent the value of your home is important to you, you can lock in some fraction of the value today, and when you leave the home, you know, if the home has fallen in value, that put option is deeper in the money, and you've received value in that bad state of the world where your house isn't worth as much as you hope. Okay, now what's really interesting from other work I've done is that HECM not only does it give intertemporal smoothing, not only does it provide these hedges, which are additional consumption smoothing, but it was an underpriced put option pretty clearly. So you would get loan to value ratios back before the great financial crisis of over 65% if you were old enough, right? The amount you can borrow is a function of your age and the interest rate. And they were giving out over 65% loan to value mortgage loans. So if you think about a senior in Phoenix or Las Vegas at the peak of the housing cycle, there was every reason to think they were giving away a very valuable option. And your total cost to close the loan would be something like 6%. So the value of the default option was considerably, really by any reasonable standard, greater than that 6%. So you couldn't use excessive cost as a rationale for not using the loan. You had an embedded put option. And so even if you had no liquidity value for the line of credit, just the put option was probably underpriced. And it's a put that provides some nice consumption. It's very strange that the take-up was so low. Now, usually you have less than 5%, considerably below 5% penetration in any market. That is fewer than 5% of all senior homeowners in almost any market were taking advantage of this product. That said, there was severe adverse selection on the put option, at least from an ex-post perspective, and arguably an ex-ante perspective. That is, HECM loans were originated in the markets that had seen the greatest price appreciation through 2007 and subsequently saw the largest busts. That's where HECMs were most popular, and they were originated most prevalently around 2005. And I'll show you a couple of pictures of this adverse selection. So given we saw this adverse selection, an important question is, wow, that's a pretty different vision of grandma than we usually have in retirement finance, right? Rather than a victim who, maybe failed to save, doesn't understand financial products, maybe grandma outsmarted the Federal Housing Administration, which gave her this underpriced put option and exploited it. That's what the geographic adverse selection really looks like. But that just runs against our stereotypes, our intuitions, anecdote, and the fact that there's absolutely low take-up. And it makes us think, was that really what was going on? Or maybe people just sort of lucked in to this put option value because they took reverse mortgage loans due to capital gains pressure, right? The prices were rising, that leads to capital, makes it more attractive to borrow when your home equity grows. So you've got more home equity, it's more attractive to borrow, and then there just happened to be a bust. Maybe that's what happened. And credit line use is going to provide us an opportunity. Oh, I know that name. Okay. Yes. Credit line use is going to give us an opportunity to test the idea of strategic selection into this product because we have a test. Just because you selected to take the product doesn't mean you exercise the put option. So the question we are going to ask is, did we in fact see strategic put option use? Okay, so hopefully clear where we're going. Yeah, and I guess in terms of why interesting, let me just continue the lineup here. How you design reverse mortgages might be affected by how borrowers seem to value the default option. So if you believe, as I hope you will when I'm done, that seniors tend to not put a lot of value on the default option because, spoiler alert, they didn't exercise the line of credit put option. They tended to exit the home without having drawn the full line of credit. Given that we see that absence of valuation for the put, when designing reverse mortgages, it may be wise to limit the extent of the put option. And that could mean a lower loan to value ratio, but that's also why I presented the paper last week. If you have a sort of bid-ask spread where the lenders understand very well how risky the loan is, but borrowers don't appreciate the value of the embedded put, it's probably better to design a product where you're doing what you can to reduce put value. And one way is to design a product where the balance doesn't grow over time, or in Australia, maybe easier and consistent with consumer demand, would be just to offer a lower line of credit or loan to value. Okay, and just as a general matter, the extent to which consumers are financially sophisticated is an object of interest. But hopefully we'll be informed by this study. Okay, I'll just maybe quickly jog through some related literature with some heavier weighting on local researchers. So in the forward mortgage market, there's been a lot of testing of the extent to which options are exercised in a rational way by borrowers. In the US, you can typically prepay a mortgage loan without penalty. So you borrow at 7%, rates fall to 3%. It's good for you to prepay and bad for the lender. But there seem to be a lot of so-called woodheads. That is, borrowers who aren't clever enough to exercise the option to prepay, even though they can save themselves a lot of interest. It's challenging to separate that from, well, it's costly to refinance, so I'm going to wait out the uncertainty. And then similarly, on mortgage default, which is very related to what we're talking about, an interesting question is when you see borrowers default on their mortgage loans, is that strategic? Well, my house is worth less than I owe. Or is it just a liquidity shock and a payment problem? I can't make the payments and I have to default. And I think the weight of evidence seems to suggest that there is very little strategic mortgage loan default in the conventional mortgage market. and we'll see about reverse today. Okay, do seniors perceive the benefit of retirement products, right? Given this puzzle of absence of demand for annuities, long-term care, and reverse mortgage, is that rational behavior because our models are missing something? Or do seniors just fail to appreciate the benefits of projects? And of course, Son, Bateman, and Hannawald have the recent paper asking exactly that about reverse mortgage loans. But there's a lot of literature on all these aging products. Usardi, Mitchell, and Curto have survey evidence indicating a serious lack of understanding of financial products, like difference between stock and bond, how much interest you'll have after 3 years, et cetera. And there's the interest in pricing reverse mortgage loans generally. They're a complicated product with uncertainty over, as I've mentioned, both the termination date and the movements of prices and interest rates. So just a reminder, when I talk about this put option value, effectively borrowers owe the lesser of property value or loan balance at the date of termination. So the put option value is the greater of the difference between the balance and the value of the property, or zero. What I learned Friday, I've inserted into this text. Admittedly, this seems like small potatoes in Australia. You've got a $2 million property, you can borrow 25% loan to value. And, you know, I mean, you can get underwater from a position of 25% loan to value. This is an accumulating loan if you live long enough and interest rates are high enough. But it's a lot less likely than with a 50% loan to value. And the issue in the US and parts of Canada is it's hard to make an attractive loan for a small loan to value, because 25% of a $200,000 home, it's just, you know, not enough necessarily to interest the borrower given the cost of originating the loan, et cetera. And so you may need high loan to values to make the product compelling. Again, Australia, I can see an argument, well, you know, this just doesn't apply. Yeah, please. Right. Right. It's a function of the interest, the 10-year interest rate at origination and the borrower's age. So if I'm a 75-year-old in a 2% interest rate environment, I might be above 70% loan to value in the old days. But today, so it's lower today for two reasons. One, interest rates have gone up, but two, after the great financial crisis, they really cut back. So I think, you know, you're at like 65% in your mid 70s in the data I'm going to look at. So, you know, definitely a real chance of getting underwater. Yeah. That is a really good question that I've tried to have answered, right? So what is the no negative equity guarantee exactly? Your liability is limited to the property value. That's sort of stated. Whether that constitutes a credit event or not, I've tried to ask. I asked people who, there's mandatory counseling to take a HECM loan, and I've asked a counselor and they said they didn't know. So that makes me think borrowers aren't warned that it would be an adverse credit event. It's a very good question. Now, you know, if you have $25,000 at stake, is it possible that an 82-year-old woman would value the ability to borrow more at $25,000? I'm somewhat skeptical. She's bankrupt already, so. But the answer is I don't know, and that's something you're asking exactly the right question, right? Because it's you have the put option. Is it really a put with zero exercise cost? Yeah. Correct. Absolutely. Right. So, you know, that's a really interesting question. Maybe I'll give a couple of anecdotes, if I may. Okay. So one is I was at a reverse mortgage conference talking to a lender about this issue. And he was telling me about his client, who was a police officer, California Highway Patrol, CHIPS, if anybody's of my generation knows what that is. And so he said the guy was thinking about selling his house, and he told him, don't sell the house, stay in the house. You know, you're going to owe more than the loan is worth anyway, so why not stay? And he said, he was a police officer and thought that would be morally wrong, right? He said, no, he thanked me. It just hadn't occurred to him before. I took a taxi once to my in-laws, and I wanted to, it was a long ride, so I split it with someone, and the person I split it with was a retiree who lived in Tampa, Florida. And of course, I tried to steer the conversation to reverse mortgage in a gentle way. And it turns out she was a borrower. So this was like my lucky day. I had an hour taxi ride with a reverse mortgage borrower in Tampa, Florida, who had taken the loan right around the peak of the cycle. And, she said, well, I was the only one of my friends who understood the product. It's too complicated. And I tried to elicit from her some recognition that she had borrowed more than she would be able to pay back, and that was a good thing for her to have done. And it's clear that that had not occurred to her before. So I think lack of awareness and appreciation of this option is probably a big deal. Whether people think there's a credit cost, I think, is really interesting. And, there could be a moral compunction too. It could be just people it feels wrong. Maybe I feel bad. I can believe it. Okay. Anyway, I mentioned this peculiarity that this was like a ticking time bomb of default optionality, because the amount you can borrow at any date, if you haven't already drawn the max, it's not the original line of credit. It's the original line of credit increased by the loan interest rate, which is a spread over the riskless rate. So, and this was one more call I had when this paper was really motivated by a call I had, because I was wondering around 2009, how could you not have originated these loans at the cycle peak in places like Phoenix? So I Googled Sun City, which is a retirement community around Phoenix, and I asked the #1 listing for reverse mortgage lender Sun City, how come people wouldn't take it? He said, I know. I tried to explain to people, don't use the line of credit, just take it as a put option and you'll be better off. But nobody would listen to me. So, yeah. Yes, as I mentioned, post great financial crisis, maybe pricing went up. I just don't remember. But the big thing is the line of credit amounts fell. The other thing they stepped in to do was along the lines of my last paper. A lot of terminations turned out to be defaults that people couldn't afford their property tax and insurance. So they created this annuity-like life expectancy set aside. So if you're low income and maybe bad credit, they require you to take some of the loan proceeds and put it in an escrow account that pays your property taxes if you're unable to. So in that way, they reduced default optionality. And the big thing again was the change in the schedule of loan to value, even conditional on age and interest rates. Okay, so let's go back to contracting frictions. Here I have a different picture. I don't have Jean Calment for adverse selection. I have two views of grandma. One is nice grandma. One is from fiction, you may know, not very nice grandma. And today, right, there's a lot of dimensions of adverse selection, moral hazard, and uncertainty within reverse mortgages. I'm not going to talk about termination. Really, we should be probably doing a competing hazards model, which is where I'd like to take this research, which is a borrower in a given year can exhaust the line of credit, or they can just sell the house, right? So if I want liquidity, I can draw on the remaining line of credit, or I can refinance. And there's a lot of refinance in reverse mortgage. And some of it, I think, was pretty fishy in this data set. Not going to talk about adverse selection on termination. Appreciation, of course, we'll recognize that there's been different appreciation across markets. Won't talk about selection or moral hazard on appreciation per se, other than to note there was terrible adverse selection on appreciation. But the big thing we'll focus on is moral hazard on credit use. That is, if the borrower uses the credit line strategically, the lender doesn't accumulate interest for most of the loan. They just have to take this put option cost on exercise. So that would be a particularly strategic way to use the line of credit. But of course, it's consistent with strategy to just draw the full line of credit immediately at origination. If I have the liquidity demand, if I want to borrow at 2% above the riskless rate per year, I can grab the credit line, whether or not I want to exploit a put option. And I'll talk about dealing with that econometrically. Yeah. Typically, yes. Right. So a credit line that's fixed rate is a no-no, right? Because, of course, you would strategically only draw when rates moved in your direction. So they don't offer that. There are fixed rate loans, but they're all lump sum.
It's already moving to my
why would people refinance when rates fall? Well, number one, when rates fall, if prices have risen, you now could get it a higher LT, higher credit line just because of the need. But additionally, there's also a higher LTV because the available funds are a function both of today's interest rate and your age and the property value. So you can't surf and raise, the age, doesn't allow you to ratchet up per se, but if rates are falling over time, you can borrow more with falling interest rates, and we'll see that. I actually think there's quite a bit of appraisal fraud in some of the refinance that we'll see, and I'll show you some evidence of that. Okay, I showed you this picture already, adverse selection. I'll show you a different adverse selection picture. But recall the horizontal axis, each dot is a zip code in the US or postal code. The horizontal axis is how much of a boom in home prices did that 3-digit zip code see between 2000 and 2006. And the vertical axis is how bad was the subsequent bust between 2006 and 2012. And notably, independent of HECM demand, there's a very strong positive relationship between the magnitude of the run-up in prices and the magnitude of the subsequent bust, and a lot of that is subprime, as we'll see. But the circle sizes or bubble sizes are proportional to what fraction of senior homeowners in a given postal code took a reverse mortgage between 1992 and some year 2006. Maybe 2012, and you just see tremendous selection, right? The dots tend to be small in the markets that didn't see busts, and they're big in the markets that did see busts, and that motivates the question about strategic use, because it sure looks like grandma was onto something by taking the loan in a geographically selected manner. Okay, here's another picture in terms of time series. So first of all, just for those of you who don't remember, the blue line is home prices in the US. And here, so this is a time series on the horizontal, the vertical is a home price index. And the blue line is a home price index if zip codes are weighted by the number of seniors who own homes in that zip code. So people who would have been eligible for HECM over age 62. And there's a big boom from very unusual from about 2004 to 2006, and then a giant bust. Now, it's more pronounced if we weight by the HECM penetration that I saw in the previous slide, right? We saw there was geographic adverse selection. So if I don't weight by how many senior homeowners there are, but instead I weight by how many HECM borrowers there are, well, then the boom and bust is more severe because I'm weighting the zip codes that had more demand. And then you get even more severe boom bust behavior if you weight by HECM penetration between 2004 and 2006, because HECM A became more popular between 2004 and 2006, but demand shifted to the sand states, Arizona, Florida, Nevada, and Arizona, Florida, Nevada. Arizona, this is terrible. Arizona, Nevada, there's one more in the West. California, and California, Florida, Arizona, and Nevada. That's where the biggest boom and bust was, and that's where the loans went. One more line and then a question. So the purple line, what a horror show. This is the number of originations into HECM by year, scaled to some level. And obviously originations really peaked right around when the home price cycle crested. So terrible selection, both in geography and time, and geography within time. Yeah.
Makes you so sure this is a demand side story, because there is, the more I talk to lenders, a real challenge is the credit facility that you can give out, that you need as the input into your business model to bring out credit. And so I'm wondering if that was just the time where cheap credits was involved.
I think that's an excellent observation. And if we don't see strategic credit line use, sort of suspending the giveaway that I've already given, if we don't see strategic, maybe it's a push. And now subprime was unquestionably partially driven by the supply side. I mean, it just has to be because it's so geographically concentrated, and it happens to be in the 4 states where one of the real innovators in horrible lending, Long Beach Financial, happened to originate its loans. So you know, I can believe the reason prices boomed in the US is because people were calling up and knocking on doors and saying, boy, you know, you should really take money out of your house. You should buy a bigger house. You should buy, even though you don't have credit to buy. And that could have pushed up prices. And I'll show you the geography of it. It is very concentrated in areas where you think reverse mortgage would be attractive. The only problem with that story is causality, right? This is like 5% of seniors. So it's a very small part of the market. By itself, reverse mortgage couldn't have driven the price cycle, and it's different lenders. So the same person, I don't think, would work for Financial Freedom, the reverse mortgage lender that IndyMac owned, and IndyMac Bank.
Well, but in Australia, people have approached me and say, "Hi, we want to start a reverse mortgage business, and we just get a few loans and we package them and sell them and trash them and sell them to superannuation funds and assets."
Yes.
And I think, great. The only problem is your story
Yes.
is that it's hard to sell, but just the idea to do this kind of tranching and securitization, and I was just so they wanted to securitize anything. And so there was just a push to do that.
So you could be right. I mean, I suppose I hadn't thought of this before, but you know, people do talk about one cause of the crisis being fair lending laws that said you need to be active in minority areas as a lender, and so there may have been demand for reverse mortgage loans securities for that reason. I'm just not sure. It would have been Fannie Mae, so I just don't know, but it's possible. And let me show a picture that maybe is consistent with that. So I would say it's plausible that the busts were foreseeable. Okay, so here's two pictures of the home price cycles in the US. And the first is just incredible. I don't think I've ever seen data behave so nicely as to create this nice, you know, slice of layer cake, right? So what are the colors? The red are elastically supplied areas that aren't on the coast, literally the red part of the map in the elections in the US. Blue is what economists think should be the areas that see the biggest boom bust cycles. So that's the California coast, the Oregon coast, the Washington coast, and the northeast of the US. These are inelastically supplied markets because they have water, in some cases mountains, and very strict regulations because they're politically different from the red areas. But by far, the biggest boom and bust cycle is the green areas, which are the sand states. So that's Florida, Nevada, Arizona, and the part of California that isn't on the ocean. The horizontal axis is the fraction Black or Hispanic. And so definitely the more Black and Hispanic, the more prone to a cycle you were. But also the largest cycles, and really the places where you saw the put option come into the money, were not the blue areas, but rather were the green areas, which are elastically supplied markets. And they all tend to move in lockstep in terms of prices. And then, so here's Modesto, California, which a lot of the sand states look like in terms of prices. Elastic supply, prices really don't grow at more than inflation from 1980 until about 2001 or 2, and then just explosive growth simultaneously with the expansion of subprime lending and also HECM lending. And then, well, you have a big run up in a market with elastic supply. Not surprisingly, there's a bust. So it's not crazy to think that an owner here in Modesto would think, you know, I'll be lucky to ever be able to take this money out of my house again. I'm going to grab a line of credit at this valuation and likely stick it to the lender. Interestingly, you know, from today's perspective, it's not clear that this was a bubble. This market that seemed to be elastically supplied for whatever reason, you know, supply is no longer keeping up with demand. Now, these are nominal prices, but given the rental dividend, it's not clear that anybody overpaid for homes back in 2006. But from the perspective of 2012 or so, it sure looked like this had been a predictable bust. Okay, and so, you know, there could be more innocent explanations, one of which I should append copies to the bullets here. But, you know, the easy story is there was capital gains pressure. You see, you know, housing level you never thought you'd have, and now it's a lot more attractive for consumption smoothing purposes to draw the line of credit and take the reverse mortgage loan. Okay, so okay, so how am I going to test for ruthless exercise? Well, first let's talk about the data I have, because it's very nice data, the HECM loan level data. Unfortunately, the data ends in 2011. The Federal Housing Administration just stopped making that easily available Fannie Mae purchased a lot of the loans, and so I can follow histories a little longer if I ask them. But now it's more proprietary, and the data that's out there is not as good. But this is a great period. You have a boom and a bust cycle, and you see a lot. So what do we know? We know the date of origination and termination of each loan that was made in the HECM program. We know the zip code of the borrower, which we can merge onto metro area to get house prices. We know the borrower's age, marital status, and gender. Interestingly, marital status and gender were not priced for loan purposes. So if I'm an 82-year-old man, I get the same, who's single, I get the same pricing as if I'm an 82-year-old woman married to a 65-year-old man, even though the latter couple, as unusual as that would be statistically, would be much less likely to terminate at any given point. But I don't think there was much selection on that. Okay, I know the magnitude of the line of credit at origination, the loan to value. I know the loan interest rate over time because these were typically indexed to treasuries, later LIBOR. So I know the maximal line of credit at the end because I take the original line of credit and just bump it sequentially, as I mentioned, by the loan interest rate. I know the credit line draws by policy year, so I know how much they grabbed in the first year of the loan, the second, third, et cetera, up until termination. And so I can observe whether or not the credit line is fully drawn as of the date the loan terminates, if it terminates prior to 2011. And I'll assume in this paper that full use means 95% of the line of credit, right? I want to give a little bit of wiggle room, but I think I observed the actual line of credit and credit available pretty well. There's some exclusions, there's repair set-asides, and a 2% origination fee. But once you subtract those from the line of credit, there's a lot of mass of borrowers who borrow between 98 and 100% of that at origination. So if you don't draw 95, it's pretty clear you left money on the table. There was a line of credit room available that you didn't draw. And I do see an indicator for whether there was a claim made on the shortfall insurance fund. So they give the status of loan termination, and one possible status is, well, the lender asked us to repay us. I don't think that's always filled, but this does give a sense that the data basically are correct in that if you look at a terminated loan and the loan to value, if they had taken 100%, they'd be underwater pretty well. If you think the line of credit use exceeds the value of the house, about half the time there is a shortfall claim. A lot of loans, for whatever reason, there isn't a shortfall claim. Part of that, I think, is a particular lender, Financial Freedom, had a large market share. And I think they didn't make claims because they were eventually taken over by the federal government. So the federal government didn't make claims on itself. Okay, I'm going to merge all this loan information with the Metropolitan Area Home Price Index. A zip home price index would be better. Even within metro areas, there was some adverse selection. The most minority subprime neighborhoods, which saw the biggest subsequent busts, were where the most originations were. But the problem is about half of zip codes don't have complete price data. So to preserve data, I'm going to use the metro area, but you get similar results using zip code stuff. Okay, so I can mark to market approximately the value at the date of termination, and I can estimate the property value relative to the maximal line of credit. Yeah. Sure.
Age and the interest rate at that time to figure out how much loan.
So what was the first question? First part? No geographic pricing. Because this is the federal government. It's just hard for them to do. They should, but I will say about that, I think that's a really interesting question because, before 2004, I would have said Modesto is a great place to lend because it's got such stable prices. Then in 2007, I would have said, oh, Modesto is grossly overpriced because I know that home prices only bust in elastically supplied markets, right? Inelastically supplied market. That's Paul Krugman, who loves to applaud himself for saying how smart he was that he knew that you should only look for the bubble in the blue areas. Well, the big boom bust was in some, well, okay, so that's a terrible market because it's elastically supplied. Oh, wait a second, I'm wrong. So, I think we should be pretty modest about our profession's ability to price. Yes. Ah, that's a great question, whether there's a bequest motive or not. I mean, I suppose a bequest motive would make me want to exercise the default option more because it would pollute my credit score, but not my children's. But no, I would know couples, but I don't know how much signal that would give me. That's a very good question. So are there any questions from the audience? I haven't checked for audience questions yet. No. Ah, very good. Okay. That's trying to be good. Okay. So that's the data we have. So what's a sort of empirical framework we can use to test for this so-called ruthless exercise? Well, let's call a bunch of variables. So first of all, a lot of people are going to exhaust credit even if they have no ruthless intent, because these are low-income seniors who have raised their hand and said, please let me borrow against my home. And a very large fraction of borrowers, 30 to 50%, just draw the whole line of credit immediately in year one. So some fraction of borrowers are always going to draw the line of credit, and that sort of complicates the analysis of whether borrowers are using credit rules. If somebody has liquidity demand in year one, I don't know if that was one of two things. It could be true liquidity demand, or it could be anticipatory ruthless full draw. So suppose my discount rate is 3, the line of credit accrues line 4%, I should wait, but it's not always feasible. I might be incapacitated at death, right? So how does the loan terminate? If I get hit by a bus all of a sudden, I can't, say, Grim Reaper, wait a second, let me call my mortgage broker and draw the credit line and enjoy my last 3 seconds on earth. And I've tried to look at medical data to get a sense of what the variable K, the fraction of the population that can successfully grab line of credit at the last minute is. That's really hard to know. A lot of people die of heart attacks, but heart attack deaths can be, you're sick and in bad condition and then your heart gives out. So you've had warning. So I don't know. We just have to sort of structurally make up. It's going to be pretty hard to know if we find strategic credit use, how strategic it is. But there is a minimum test we can do, right? We can, as a minimum, ask whether credit line borrowers who are in the money disproportionately draw. Anyway, we would expect that the fraction of borrowers of type X who terminate at date T having grabbed the full line of credit rather than not, so Y would be the fraction fully drawing, would equal liquidity demand, which is kind of a nuisance for estimation. But then for 1 minus liquidity demand times mu, what fraction of the borrowers are actually having ruthless intent, times alpha, those who drew in an anticipatory way, plus 1 minus alpha times those who don't draw the credit line fully in year one in anticipation of being underwater and incapacitated, and who are in fact capable of exercising it. Okay, so some of these parameters are real. I just don't think there's a way to estimate them, but we can still have an elementary test, which is compare the delta, the difference in full credit line draw between some borrowers X and similar borrowers who are out of the money. Okay, so do we see a difference in credit line use between one group of borrowers of some age and characteristics like gender and closing date and termination date? Do we see a difference in the draw? So the difference would be the difference in liquidity demand, plus the difference in this whole strategic term. Now, there's some problems. First of all, we have to assume that the liquidity demand is the same in one group and the other group. And you have to be careful with that, right? We know there was more reverse mortgage take-up in the big boom and bust markets, which suggests there was probably at least as much and maybe more liquidity demand, because the bigger the boom you have, the more consumption smoothing demand there might be. So conditional on taking the loan, we want to find borrowers who are similar enough, including similar in having seen a large boom. So I'm going to create a control group of borrowers who experience a big boom, but not the bust. And I'm going to hope that I can believe we have equal liquidity. It's very easy to believe that the liquidity demand would be no less among the borrowers within the money put options. And that's the requirement we need to have this sort of minimal test, okay? And so if we believe that, and an easy assumption to believe is that this whole ruthless term is no greater for the control group than the treated group. Now, if I see a big run up in New York or Washington, DC, and then don't see a bust ex post, I still might have ruthlessly selected into the program. Just ex post, I was wrong. But all I need to assume is that these ruthlessness parameters are stronger for those who selected in and were ex post correct. And I think that's plausible. If those two conditions are satisfied, then if mu is positive, if there are ruthless borrowers, then we should see a positive difference, that the ex post in the money borrowers are more prone to draw the full line of credit by termination than those who aren't. If that condition is not satisfied, well, then we must think mu is close to 0. So it's nice to write a paper, I think, where the empirical answer is interesting either way. In this case, the more interesting answer, in a way, is if we don't see any difference in credit line use, because that would be a strong indication of an absence of ruthlessness. If we saw there was more, well, maybe it's more liquidity. Yeah.
I'm just a bit skeptical about the terminology.
Please.
I'm not sure that ruthless is a good term because it puts a negative stigma onto a negative perceived product. And I'm also not sure all the people are ruthless. So I'm just wondering if I would reinterpret this whole thing in terms of financial literacy or being able to understand the product and use it rationally. So could we just, like, if I would put a more gentle story, like, now we see people having issues taking this app, but
Yeah.
can we rationally exercise the option, and can we could I write based on the same formula analysis a more gentle story, which is about how do we need to help seniors make best use of the loans they have, help them better understand it. Is this really a story about ruthlessness or more a story of capability or financial literacy, and will it sell better as a story? Because it's like nobody wants, like, I'm just wondering when you're putting too much negative spin on something that's already having such a negative price, and if it could be just.
I think that's fair enough. And a referee on this paper at one point brought that, and it was you, and then it's the second time you're saying it. A really ruthless referee. So this is the second time I've had a complaint. So yes, I will. I think, but what now? I'll make two defenses of ruthless. One is it's a term of art in the literature. So there's, ruthless mortgage default and ruthless prepayment. So it's just sort of what people use for the combination of financially sophisticated and not so constrained by a personal code of ethics that they wouldn't feel guilty. Well, rational is a good, rational and strategic. Okay, so first of all, there's Rucci's excellent question, which I can't quite answer, about credit line and hurting your credit rating. So I think it's very unlikely that any credit damage done would be more than like the $30,000 you're leaving on the table, but it's conceivable. Yeah, rational, strategic. Yeah, I think it's worth thinking about. I don't want to be dismissive of that.
Let's make sure we help people use their product in the best way so it benefits them, because
Yes.
Our research aims to help individuals. Maybe
Yes.
the point isn't, because this is so much a story from the lender's point. Like the
Yes.
we don't want people to use the product, but actually, as researchers, shouldn't benefit individuals and them make best use of it. If that's available to them, why not use it?
Well, I work in a real estate division. I think I should be helping the real estate industry.
Okay. Yeah.
No, I take your point. I take your point. And I think maybe the question, maybe a good way to phrase it would be is, do borrowers appreciate the no negative equity guarantee? Yeah, right. I mean, the question is, the real question is, was the selection driven by some appreciation of it? I think that's really worth a discussion. And I would say in the time since I gave this paper the title and today, I think we are more conscious socially of labeling than even we were, that's less than a decade ago. So I'm not at all averse to that. I don't want to be ruthless paper title. Okay. A very good point. Anyway, so here's the end, right? So if the liquidity demand is no less if the intent to exploit is no less, then we should see a difference in credit exhaustion by termination. By the way, there's not much else you can say. And unfortunately, and this is where the dual hazard really, it's annoying, is termination is non-random, right? So in the comparison group, what we're going to see is the comparison group I'm going to do, I don't want to be cute about it. The comparison group is going to be sort of blue state markets. What I do is I create two groups. One group of, I do two t-tests. I want to do cutoffs for a minimum boom that's going to put you in either the treated or control group. So that's one number. The second number is the smallest bust that lets you enter the treated club. And then the third number is the biggest bust. You have to be below a large bust to be in the comparison group. Now, there's not a lot of markets that have a big boom and no bust, but you know, and there's no markets that have a small boom and no bust. So, you know, these red areas are kind of out, and I'm basically going to be comparing a handful of these blue markets that have big appreciation but small busts, and a lot of these green areas that have both big booms and busts, because I do want to control for that capital gain. The problem is, what is a termination, right? Why would you terminate your loan in 2011, which unfortunately, you know, so if you terminate between 2009 and 2011 in one of these green areas, the treated areas, you're very likely to have terminated in the money. But why did you terminate? You know, there was no financial incentive to terminate. So you might worry about selection. So presumably these were people who either defaulted on a property tax problem or died, you know, got ill, incapacitated, and just had to move out of the house. Now, the blue states, the blue areas, they shouldn't have really been able to refinance. Interest rates fell, but very few of them, by my calculation, could have pulled out more cash than their original line of credit. We see a giant concentration in the Washington, D.C. metro area from a particular lender who had a bunch of refinances around 2009. And I asked that lender once, because the original proprietor had been fired, and you know, I think maybe they were fake appraisals, because I don't see how so many people could have refinanced, but it looks like they did. So anyway, that is one caution to the analysis. And you know, maybe a competing hazard lets you account for that in some way. I haven't thought that through. Okay, so I talked about this control group, and you know, the control group is almost entirely the northeastern U.S. coast. Honolulu, Hawaii also qualifies as a market that had a big boom, but a small bust. And all the markets that are treatment are sand state markets, in some cases, California, Nevada, Arizona, and Florida. Okay, so let's look at differences unconditionally between these two groups, and then we'll do regressions. So what's important, the median boom in the comparison markets is just a little bit smaller than the treated markets, 1.83 versus 2.09. The markets that are neither comparison nor treated, by the way, you know, neither comparison nor treated, only saw 20% appreciation instead of 80 or 104. So you know, quite different. And then the median bust. So the median peak price was 2.26, the median post. So the prices fell more than in half. In the treated areas, they fell by about, you know, 30–40% in the control group of metropolitan areas. You know, here's the elasticity of housing supply, right? Interestingly, the treated groups saw 26% more supply growth than the comparison group. And presumably that's part of the story of why they saw a bust, but the comparison groups were able to see relatively modest busts. They didn't face oversupply as well as the end of subprime lending. Okay, so the key difference that we want to look at is credit line use. And right, so what fraction of loans used more than 95% of credit right off the bat in year one? That's that liquidity nuisance that we just have to account for. 37% of borrowers in the comparison areas did, 42 in the treated group, actually more, the most were in the other group. So I sort of went to a lot of trouble to create comparable borrowers who experienced similar run-ups in price, but maybe not necessary. And then what fraction of loans terminated with more than 95% credit use? It is a little bit more. So unconditionally, we do see a bit more exploitative, full line of credit use in the treated than controlled, but it's really not a dramatic difference. So here's a plot. The solid line is the treated areas, and the circles are treated, I'm sorry, the line is terminated loans in the treated areas. And the horizontal axis is what fraction of your line of credit did you use in year one? And the vertical axis is what fraction terminated having fully drawn. And what you can see is if you didn't draw 100% in year one, you're very unlikely to have grabbed the remaining line of credit prior to termination. And this isn't data error. I've compared this with Fannie Mae proprietary data. It's just there's not a lot of use after year one of the credit line. So we can see the more you drew in year one, the more likely it is that you subsequently borrowed enough to terminate underwater, but it's quite unusual. Here's the regression of interest. I'm almost out of time, and that's fine because we see the bottom line, which is having a credit limit greater than collateral at termination across specifications conditional on the date you closed your loan, the date you terminated your loan. Was financial freedom this particularly bad lender your lender? Was it a third-party loan that was sort of originate to distribute? What was your appraisal? Higher appraisals tend to use less credit. Okay, and what do we see? Never a significant difference in credit exhaustion between the two groups. There is a positive difference of about 2.5%, and you can make some assumptions that allow you to believe that up to 10% of borrowers were ruthless, but we can't statistically reject, whatever the word is, we can't statistically reject that there is no strategic exercise of the put option. Okay, and we can bound the difference at a relatively modest number because the standard errors aren't huge. Okay, so what does this tell us? There's not a big difference in credit line exhaustion. So I'm almost out of time. I'm happy to take questions, but let me just conclude. Okay, so we're seniors both sophisticated and willing to exploit that sophistication. There was spectacular adverse selection into HECM. There was a very attractive put option. This is a lot of money. You know, this can be tens of thousands of dollars on the table, but not a lot of people borrowed against the loan, so we didn't know ex ante. The evidence suggests not, right? You look at this picture, and you look at this picture, and if you didn't borrow at all, probably because of liquidity demand in year zero, you didn't ultimately complete. Directions for future work. I think you might want to do a competing hazard model of either exhaust credit or refinance. As I mentioned, there is some very fishy refinance around Washington, D.C., which is pretty interesting, and you might sell the property. In terms of design, going exactly what you mentioned, Katya, it looks like seniors don't value this default option, which tells me you want to design a product to minimize the default option value, which is appreciated by the lender and apparently not by the borrowers. And so the annuity scheme or just limit LTV as Fannie and Freddie have done after the bust. Unfortunately, that lowering of LTVs in the US context has been associated with a significant reduction in demand. So again, hence the annuity idea. Okay, thanks very much. Happy to take questions if there's any time.
So I would like to thank Tom again for the wonderful presentation, and thank everyone on site to ask very interesting questions, and it really stimulates the very interesting discussion. And I would say let's have lunch for people participating here in the room, and to thank everyone online. I will see you in 2 weeks' time. Thank you.
Thank you.